Save or invest? Here's the main conditions to consider. Saving and investing are two related strategies for achieving financial security. To save or to invest, you must forgo spending now to build wealth for your future. Whether you've been working on your finances for years or you're just getting started, it can be difficult to know when you should be saving and when you should be investing. Wondering whether you should save or invest? Well, get your pen and paper ready as we give you the main conditions to consider and the guide that will help you work out how to build up your savings and analyze the vital variables for investments. And to top it all off, we'll cover the basics of planning out your finances for short-term savings and long-term investments. So before you get too excited, make sure to tap that like and subscribe button first and ring the bell to get the newest videos from Billionaire Crypto Investor. Saving versus investing. The difference between saving and investing is whether you hold your unspent funds in cash or in some other form. Saving means setting aside cash for future use. Savings is a cash activity. You can hold back from spending cash and instead keep it in a savings account, a certificate of deposit or CD, or somewhere in your home. The goal is to have those funds available for later use. Saving is the safer route because the dollar amount in your bank account won't typically decrease unless you withdraw funds, but interest rates on saving accounts don't allow your money to grow very quickly. It's important to track your savings, putting a deadline or timeline and value to your goals. For example, if you're saving for your annual family vacation, you might want to target $3,000 to save in 9 months to withdraw at the end of the year. You then know how much you need, how much to save monthly, and the ability to take the money out without fees to spend on that treasured vacation. Unfortunately, interest rates are often lower than the rate of inflation. This means your savings could lose purchasing power over time. Investing means using cash to buy other assets that you expect to produce profits or income. When you invest money, you use your cash to buy another asset. The goal here is to earn profits or income. Examples of investing include buying stocks you expect to appreciate. When the value of the stock rises, you can sell it at a profit. Buying stocks that pay dividends. You can use the dividend income to pay bills or to buy more stocks. Buying real estate that earns rental income. The rents you collect should create profits after you pay your property expenses. Buying bond mutual fund shares that pay interest. As with dividend payments, you can use the income to pay bills or to buy more mutual fund shares. If you buy more shares, you benefit from compound interest. This is when your interest starts earning interest, a powerful way to build wealth over time. When investing, it's important to invest wisely. You'll have a better return if you begin investing early. Understanding different investment vehicles, what they are for, and how to use them is imperative to being successful. We invest for long-term goals, such as our children's college fund or retirement. We use specific vehicles that allow for growth. These allow for withdrawals when your child goes to college. Long-term college plans can help you successfully reach that goal. It's tempting to want to invest to receive higher returns and beat inflation. Unfortunately, the value of your investments won't always go up. In some cases, investments can become completely worthless. So how do you know when you should stick to the safer route and save or risk more to earn bigger returns and invest? Should you invest or save? Prioritizing saving over investing can be tough. Here are some guidelines to help you decide which comes first. When you should save. You should save when you have income but little or no cash on hand. Set a goal to build a cash savings balance that can cover 6 months of your living expenses. This protects you from unexpected financial emergencies such as a car wreck or job loss. Saving is also appropriate for short-term financial goals. Examples include buying a home, paying for college, or funding a wedding. If your timeline for reaching the goal is 5 years or less, saving is a better strategy than investing. Note that high-interest debt balances can complicate your savings efforts. Some will argue it's better to pay off debt before you save. However, living without an emergency fund is risky. Should you have a surprise expense, you'd have to borrow more to cover it. To avoid that scenario, save what you can as you repay debt. How to pick a savings account. The right savings account will be easy to use and free of monthly charges. Consider these pointers as you weigh your savings account options. Is the interest rate competitive? Interest rates on savings accounts vary widely. Look for a high-yield savings account to help increase your money. Can you automate deposits into the account from your checking account? Check the fee schedule. Will you incur fees for normal account management activities? Is it easy to withdraw or transfer money from the account? Are there free ATMs nearby? How long will it take to transfer money back to your checking account? Are there extra features that make saving money easier? Some accounts have broader savings management capabilities. You might set up multiple savings goals, for example, and track your progress against each separately. Saving is the higher priority when, number 1, your cash savings doesn't cover 3 months of living expenses. As previously noted, cash on hand keeps you afloat through unexpected financial challenges, such as job loss, injuries, and other emergencies. Number 2, you're targeting a short-term financial goal. If you want to buy a home within 5 years or pay for your daughter's wedding next year, it's best to save. Investing is too risky when the timeline is short. When should you invest? You should invest when you have income, a cash emergency fund, and no high-interest debt. Cash emergency fund. This cash helps you manage the risk of investing. Any asset you buy can lose value or fail to produce the income you expected. Stocks, for example, rise and fall in value daily. It's easier to tolerate those normal ups and downs if you have another source of cash available to cover financial emergencies. Without cash on hand, you may have to sell your investments quickly if something bad happens. Selling too soon limits your profit and/or income potential. Worse, if you sell when your asset's value is temporarily down, you may lose money. No high-interest debt. Paying off debt provides a guaranteed return because you're spared future interest expenses. Investing is less certain in terms of return potential and timeline. Take the sure thing and repay your high-interest credit accounts before you start investing money. You're ready to invest when, number 1, you can afford to keep the money invested. Investing requires a minimum timeline of 5 years. In shorter timeframes, the stock market can be volatile. The shorter your timeline is, the less likely you are to see the results you want. Number 2, you're preparing for retirement or another long-term goal. Investing is ideal for long-term goals. With stocks in particular, a longer timeline allows you to practice buy and hold investing. This involves buying shares in quality companies and letting them appreciate for decades. It's the simplest way to build wealth with stocks. You can also save and invest at the same time. For example, you might contribute enough to your 401 to max out your free employer matching contributions. Meanwhile, you can add to your cash savings until you reach your target balance. Once you reach your cash savings goal, you can pause those deposits and increase your 401k contributions to ramp up your retirement saving. Saving and investing are two levers you can pull to achieve financial security. Saving is for your short-term needs, and investing is for the long term. Master the skill of using both to achieve your financial goals, and you'll find prosperity on the other side. Which of these two have you started? Do you have any other suggestions on how to save or invest? Give your ideas in the comments section below. Let's help others elevate their finances by sharing the information through sharing this video. This is Billionaire Crypto Investor. Like, subscribe, and see you again in our next video.